Everyone, welcome to today's session. Let's jump right into it here, and we'll start out with our top-down approach where we're looking at current market conditions and pardon me, looking at the long-term market timing signals here. And a lot of this is repetitive because it is such a slow-moving indicator, a slow-moving chart that we have been talking about where we've been at really since, all summer long, even into the springtime. We've been sitting in the upper end of this range. Typically, anything above 20 starts to be really elevated right there. So we've been above this 20 level in terms of trend momentum for quite a while, and we were at the upper end of this range. Obviously, you can see that on the chart itself of the S&P 500 in the last 20 years to see where trends are shifting as well. That's the red and the green arrows. When we get a downtrend shift, we get a new uptrend shift. So we get those along the way in the last 20 years. And what we're trying to focus on primarily is where are we at in that trend? Are we really elevated into this trend, or are we starting and a little bit earlier in the trend, or are we topping out, or are we in a downtrend? And those are going to affect the decisions that we make based on what the market conditions are currently doing. We don't just want to just jump in and act in the market conditions for any reason. We want to have a plan, because as markets drop, stocks are going to drop. Whether it's a good stock, a good quality name, or a good quality company, I've said it before, no such thing as a safe stock. All stocks in downtrends and in bear markets will drop. And in some cases, they can drop even more so than even anticipated, just because we hear of a name, for example, like General Electric or, Caterpillar or 3M. Sometimes even those stocks can drop 20, 30, 40%. So we want to be aware of what the long-term bullish or bearish market is. Now, we've been in this, and that's really what the top side of this structure is for. Where are we at in the trend? We know that we're at the upper end of this trend. We know that trends ultimately do, I've said this before, that the stock market is designed and built to always go higher. And the reason why is because the S&P 500 and all of the indices continually rotate stocks out of the indices and replace them with new companies that are working. Apple and Google and Facebook and Tesla and all of these stocks that didn't exist 20 years ago are now key components, and even more, key components based on the current technology are always replacing that. So that doesn't mean that all of those newer stocks can't have retracement as well. It does, but it doesn't mean that they're going to go bankrupt and, have a blockbuster video scenario that is now Netflix. At some point, there's going to be some kind of a new technology that even replaces that technology. And so the indices are designed to always be looking for those companies. And what we are trying to do is find those companies, or uptrending good quality companies that are growing, that maybe have a new technology or new idea or something that is relatively new or in high demand currently, and that the underlying company producing that good or services is also increasing rapidly. And we want to participate in those types of stocks and those kind of companies. And we are trading in and out of those. We're not buying and holding those over a length of time, although that's not necessarily a bad strategy. It's just a longer term strategy. And it can create, if you're like, I don't care if it goes up, 200% and then down by 50% and then back up by 400% and then down by 50%, as long as that you're understanding that that's a possibility and you own the kind of a name that is not going to go bankrupt, that any company is at risk, obviously, but that's really what we're focusing on for the most part. And for the most part, we end up getting per stock about 3 or 4 signals. So, you buy and sell an individual stock. If you're just following one stock, probably 3 or 4 times throughout the year. What we don't want to do is get caught in a downtrend and get stuck holding a stock that we don't want to own. Our anticipation was for it to be a trade for a certain length of time, and then it retraces and we don't stop out or we don't sell it, and we end up holding on to it for way too long. Let's talk about some of these shorter term signals. We are seeing some movement back in momentum. We're seeing move back into into breadth as well, and also seeing sentiment weakening here. So we are seeing some softness in the overall internals that are starting to happen. Also buy-sell ratio, which has got a bit of a bearish tone right now at 0.85 buy-sell ratio, meaning we have more sellers than buyers, just barely. But But we are losing some of that bullish momentum, and that is also showing up in the breadth of the market currently as well. Let's jump over and look at the S&P 500 because we've got a price range that is relatively tight right here. These lows along the bottom and these highs along the top of this range. At some point, this is either going to break to the upside or it's going to break to the downside. There just hasn't been a catalyst. There hasn't been news or any update on information that's known or anticipated to shift the market currently. And so it's just kind of consolidating right here, which is obviously better than going down. But if you're getting selling along the way, institutional selling in these consolidative type locations, that could be happening, and some of those internal indicators that we were just looking at could be, that could be noting that we are seeing some selling, maybe not on some of the big stocks that are holding up the market, but some of the ones that are not. Okay, so S&P 500, that's our current status here on S&P 500. We're still bullish, still in this bullish trend, but we're hovering. See, we've kind of gone back and forth right here. There's yellow. That's just moving us back into this range, which is really that hold range. Okay, remember what the colors are telling us. The colors are telling us that we're trending or we're not trending. When we're green, that means we're in momentum. And most of the time, if we go out to a little bit longer time frame, most of the time we are trending. We are in longer term uptrends with a little, spattering of non-trending, or we're in downtrends. The red and the yellow, notice the yellow for the most part those are the transition phases. So when we start to see more yellow, that's a transition either to a pause of the uptrend or a transition into a downtrend. And ideally we want to be focused on stocks that are continuing that uptrend, that are in a momentum zone to the upside. Let's see if this is an example here. HIMS, this has been a kind of a high flyer here in the last, this is a 2-year chart, and you're seeing an example of this that goes up really quickly, can go up really quickly, but can also, once that starts to shift, starts to come down pretty quickly. So we're also utilizing our stop loss location. So a lot of times we get stopped out before the trend really starts to shift, because that, in essence, is the money management process of getting out a little bit earlier. It still gets very close to where a trend reversal starts to happen as well. And that's what we want to do, is we want to get out of a bullish trend before it turns into a bearish trend. And the yellow gives us an area to say, okay, I'm going to either tighten my stop loss, or I'm going to sell some of my position size, or I'm going to just bail out entirely, or I'm going to ride it out, okay, or whatever this strategy is. This gives us an opportunity to say there's some weakening here. We've got to be listening to the price action and not necessarily telling the price action what we think it should be doing. That just doesn't work. We've got to be following what price activity is telling us, and then we want to try and position ourselves in ways that are taking advantage of those trends. Now, obviously, we're going to get scenarios where we get a rally higher and it doesn't continue, or the market retraces and we get some pullback. But as you can see here in this case, that's ultimately what we're looking for. If we were to back test this last 2 years just on that chart alone, it'll give you an idea of some of those trends that they look like. 13%, 40%, and then a couple of losses because we're buying in. It didn't follow through. It retraced. It stopped us out, or we had sell signals. And then we also have some nice gains. So this for the last 2 years, and the other portion of this is your drawdown, 20%. 75% winners. So of the total number of trades, which were 8 in the last 2 years, then we had 6 winners and 2 losers. And those 2 losers took the total equity curve down by 20%. Okay, a drawdown on an equity curve is basically this right here. You reach a high water mark. In this case, we started with 10,000, get to 15,000, and then those 2 losers in a row create drawdown. In this case, it was a drawdown of 20% from that high water mark, and then the rest of those moves continued to move higher from there. That's back testing what this stock would have done if all we would have done is just followed these signals and gotten in when we had a new momentum signal and out when we shifted back to red. Okay, and that's a pretty good example of how most stocks, or how trending stocks, work. Some stocks don't look like this because they're not trending, or they're in a sector that's not really being paid attention to, and there's not real massive upside potential for a new technology. You know, medical and biotech and technology and all of those are really good areas to look for momentum stocks because they are new technologies and everybody's looking for that. If you're in something like, you know, a basic material or gold stock, or you know, something that it's like, and there's not much new technology, there's not much newness that can happen for massive growth and new eyeballs or new consumption of whatever that overall product is, then those are sectors that are a little bit tougher to follow, to get really big moves. Obviously, you can get cyclical type of moves if gold is moving higher and gold stocks are producing well, or oil is moving higher and oil stocks are trending for the time being. Those can also be areas to focus on portfolios. Also, one of the things I wanted to focus on also, so let's go back to market conditions. Again, just we're mildly bearish because we have that hint of downturn. The internals are starting to weaken. And this is another indicator when we look at the sectors tab and we look at what's happening overall with these core sectors. And you can see the short-term trends. We've got about half down and about half up. That's a good indication of what our mildly bearish indication is starting to tell us. And that is markets may be starting to soften or weaken. It doesn't always necessarily mean that the entire thing is going to fall off the table and we're going to go into a bear market entirely. What it does mean is that there's a shift. There's some shift in the supply-demand equality, and it's moving away from uptrend and more into a neutral or bearish type bias. For the time being, buy-sell ratio also gives us that idea. Are we at an extreme range here, or are we starting to get bearish? And what that could mean is what's my allocation towards my portfolio? How big of a position size am I going to take? And let's actually look. I wanted to go over, NVIDIA showed up as a new buy the other day. And obviously NVIDIA is a high flyer in VDA. That came out kind of funny there. So up 4% today, into new buy zone and back into momentum as of 2 days ago. We entered into it yesterday in the wheel portfolio. But I wanted to go through an example of a brokerage entry. I'm using Webull, which is it's a really cool brokerage platform. I like it because it's very chart intuitive and you can do a lot of things on the chart. So one of the things I wanted to focus on here is if we were taking an example of NVIDIA and we were going from, and we were at our entry in the morning and we were saying, I'm going to make a trade on this stock. Let's do it as of yesterday. So we've got today's market activity. And I said, okay, here is my criteria. I've got my signal. I know my number of shares because I've got my portfolio size. And then from here, I'm going to go out and say, okay, let's say if I have $100,000 and I want 100 shares of NVIDIA, obviously that's a pretty big portfolio position size. I'm not going to be able to do that. I'm at 11%. I got to come way down to my plan, my portfolio plan, which is 2% or right around 2%. So 20 shares puts us at 2.3%. And then obviously we would want a stop loss on that as well. So our stop loss, let's take it below the lowest point of the most recent retracement or the most recent hold signals before the buy. And in this case, it's right around 115. We'll just say 115 for clean numbers. Okay, and 115. That puts us at 0.3. That's an acceptable position size trade. It's the upper end of the range that we're looking at right now, just based on market conditions right here and the risk structure that we're utilizing in our portfolios. But in this case, this would be ideal. Okay, so now what I could do is from here, obviously we're not a brokerage platform. We're not going to make a trade from here. This is just setting this up so that we can track it. We can keep track. We can organize kind of our thought process inside of this methodology. But from here, if I wanted to go out and make a trade on this, I would just come out and I would say one of the cool things about this is you can set up what's called a bracket order very simply. And I like to do this directly from the chart right here. It's a chart called Chart Trader. And if I were to buy this stock, Okay, now let's say that this move hadn't happened yet, and we're sitting right here. I can click on buy, and then I can come down and I can set my limit order. A lot of times in the morning we'll say, we don't know what the market's going to open at, although we can usually take a look and see pre-market. But if I said I don't want to pay anything less than $132, then I can click that. The other thing that I can then do is I can drag this down and it automatically will establish my stop loss. Okay, we said our stop was 115. Well, there's 115.08. I can tighten that up a little bit more once I'm done. Now, I can also drag it back to the upside and I can set a target. So initially, I can just set that target way up here in the stratosphere or around 10%, because a lot of times that 10% is our first exit amount of well, I shouldn't say that, but it changes. We can have, if the stock is up 10%, we can sell a portion of it if it's up 20%, depending on what the plan structure is. Or we can just say, let's cross that bridge when we get to it. Okay, now from here, again, this is pre-market. We have an open. I would click on place order. Now it immediately will set up my buy order, and it'll immediately set up my stop loss order. There's nothing else I